If you think investing means only stocks, this video is for you. Hi, this is Manisha. Welcome back to the channel. This is Mutual Fund Basics Part 3, and today we will discuss debt mutual funds, a relatively safer option to invest your money. And we'll cover what are debt mutual funds, where do they invest, their taxation, and if you should invest in that or not. You may check out the part 1 to understand what are mutual funds. The link is in the description. Most people think that investing means only stock market, which is risky, and therefore they decide to keep their money into bank accounts so that it remains safe. But debt funds are the best option for someone who is looking for stable and fixed income and does not want to take that market stress. So let's start with what are debt mutual funds. Here the pool of funds will be invested into fixed income securities, and as the name suggests, these are securities that provides you with regular income. See, company needs money for business expansion and government needs money for public welfare. So like taking loans from bank, they are taking loans from public and promise to pay a fixed interest and principal amount back at the maturity. So government issues bonds and treasury bills and companies issue bonds and debentures. So debt mutual fund invest in government securities, corporate bonds, treasury bills, commercial papers, certificate of deposits and money market instruments. There are different types of debt mutual funds based on the duration and the types of securities they invest in. Like overnight and liquid funds invest in securities with maturity of 1 day and 91 days, and therefore they are highly liquid and best for short-term investment goals like maintaining emergency funds. Other types as mentioned here are based on maturity of the securities they hold. Like low duration fund invest in securities maturing within 6 to 12 months, and other types of funds invest in a particular type of security. Like corporate bond fund invest in corporate bonds, and Gilt fund invest in government bonds. Banking and PSU fund invest in debts of bank and PSUs. Now let's see how much risky it is and what are the returns we can expect from debt mutual funds. When you invest in equity, you are getting ownership. So you get both the risk of losing your money if the stock market falls and very high returns if it performs well. But in debt, you are giving loan to government, big companies and banks. So your money is in safe hand and you will get not very high but stable returns. So risk in debt funds is less than equity and hybrid funds. And if risk is less, returns are also less than equity and hybrid funds. So does that mean the risk is zero here? The answer is no. See, when you are giving someone loan, they can default on that, and this is called default risk. Also, the bond values are affected by the interest rate movements and they perform poorly when the rates rises. This is called interest rate risk. Similarly, there is liquidity risk when it becomes difficult to sell the bonds during rising rates. As we have discussed the return aspect, let's quickly cover the taxation of debt mutual funds. If you are investing after 1st April 2023, returns from your debt funds will be taxed at your income slab rate, and there is no separate benefit for LTCG or STCG. Now let's discuss if you should invest in debt mutual funds or not. Debt funds are suitable for investors who want lower risk than equity and better returns than savings account or FDs. People who want liquidity, as debt funds can be redeemed quickly and there is no lock-in period like in FDs. Also, debt funds are best for building an emergency fund or for short-term financial goals. Debt funds don't give sky-high returns, but they provide you safety, stability and liquidity. They are perfect for conservative investors or for balancing risk in your portfolio. If you found this video helpful, hit that like button and subscribe to my channel for more such content. I will see you in the next one.